Welcome to Mind Over Money. I'm your host, Peter Botha, and in this podcast brought to you by GinFi, we explore everything from smart investing to mastering trading strategies. Whether you're just starting or leveling up your financial game, we're here to help you take control of your money. Let's dive in.
Hey there, deep divers. Today, we're unpacking something super intriguing: behavioral finance in Forex trading, and then venturing into the wild west of crypto scams. Trust me, this one's going to be both eye-opening and, well, a little unsettling, but definitely worth it. So, in today's episode, we've got two incredible sources fueling our discussion. First, an academic paper that dives deep into how biases impact Forex traders. Don't worry, we'll break it down so it's easy to digest. And second, a YouTube video exposing the sneaky world of crypto scams. By the end of this episode, not only will you understand how investor psychology works, but you'll also learn how to spot and avoid crypto traps. Sounds good, right? Let's face it, when it comes to money, our brains sometimes work against us. And that's where behavioral finance comes in. So, let's kick things off with a quick question. What is behavioral finance, and why does it matter? Okay. Here's the deal. Traditional finance assumes that investors are perfectly logical. They make decisions based purely on data and reason. Sounds great in theory, right? Yeah. Well, real life doesn't work like that. Behavioral finance says, wait a minute, we're humans, not robots. It recognizes that emotions, biases, and irrationality often creep into our financial decisions. And honestly, that's where things get fascinating. Predictably irrational is what behavioral finance calls it. And let's be honest, it's summed up perfectly, don't you think? The academic paper we're referencing dives into 5 key biases that impact Forex traders' decisions. And here's the kicker. These biases aren't just theoretical. They have real-world implications for how traders perform in the market. First up, overconfidence. The paper found that traders with more capital often feel invincible, like any success they've had is purely due to their genius, even if it's just luck. And that leads straight into over-optimism. Traders might hold on to a currency they believe will keep rising, ignoring all signs of a downturn. Sound familiar? Yeah, it's a recipe for big losses. Then there's regret aversion. Imagine selling a currency only to see it shoot up later. That feeling of regret can be so strong, it pushes you to buy back in, often at a worse price. Oof. Been there. Next up, loss aversion. Nobody likes losing money, but this bias makes traders overly cautious, sometimes missing out on great opportunities because they're too scared to take a risk. And finally, representative bias. This one tricks traders into thinking patterns will repeat indefinitely, like assuming a currency that's been rising will always rise, without considering other factors like economic changes or global events. What's really interesting is that these biases aren't limited to Forex. They show up in all kinds of financial decisions. For example, buying a house, investing in stocks, even choosing a savings account. Recognizing these biases is the first step toward outsmarting them and making smarter choices. And speaking of smart choices, let's pivot to our second topic: crypto scams. The YouTube video we watched painted a pretty grim picture. Billions of dollars stolen. These scammers are pros, and they're targeting everyone from newbies to seasoned investors. The video broke it down into 3 major scam types. First, there are fake websites and direct messages. Like the story of a guy who got a message on Telegram from someone he thought was a friend. They recommended an official-looking website with all the bells and whistles, certificates, addresses, white papers. Totally convincing. Until it wasn't. He invested $15,000, and his friend and the website vanished, along with his money. It's the classic too good to be true trap. You know what I'm talking about. The second scam involves impersonating support staff. Scammers lurk on forums like Reddit, pretending to be helpful community members. They throw around tech jargon to confuse you, and before you know it, they're asking for your private keys. It's sneaky but effective. And the third one, fake airdrops. These scams send you worthless tokens that look legitimate, but interacting with them can drain your wallet or steal your funds. The rule here? If you didn't sign up for it, don't touch it. Bottom line, skepticism is your best friend. Be wary of unsolicited offers, verify everything through official channels, and never, ever share your private keys or seed phrases. And for those of you trading Forex, remember to keep those biases in check. Stick to a plan, diversify your investments, and don't let emotions dictate your decisions. As they say, slow and steady wins the race. That's a wrap for today. If you found this episode helpful, share it with a friend and let us know your thoughts on Instagram GinFi Podcast, and don't forget to rate our podcast from wherever you're listening. Until next time, stay curious and stay cautious.